Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, July 23rd, 2020. Hope you're having a fantastical day out there in the interwebs. It's a hazy day here in Colorado. There's a fire or something. I had to run into town to grab some things, and you couldn't even see the mountains. I mean, which is pretty hard to do since the mountains are just like right there. So anyways, hope you're having a fantastical day. And if it is your first time watching your Liberty Call, you could do me a favor. Give me some thumbs up, a like, a share, subscribe, follow, and press that notification bell. All right. Looks like the markets took a crap this afternoon. I'm not sure what totally happened, but let's go ahead and dive in and see what's going on there. Dow Jones was down 0.14%, 57 points, closed at 43.58. S&P 500 down 0.16%, 8 points, closed at 55.55. NASDAQ down 0.05%, pretty flat, 8 points. Closed at 17,998. The VIX was down also 1.27%. It's at 1472. Canada down 0.26%. Brazil down 0.96%. Mexico down 0.52%. Jumping over to Europe, Germany was up 0.77%. The UK down 0.38%. France down 0.31%. The Netherlands down 0.22%. Spain up 0.62%. Italy up 0.07%. Switzerland down 0.09%. And same with Portugal. Russian exchanges, both in the green today. The MOX up 0.07, the RTSI up 0.62, and the Asian markets, the Nikkei in Japan was up 0.12%, Australia up 0.5%, New Zealand up 1.03%. In China, the Shanghai was down 1.65%, Shenzhen Component down 2.97%, China A50 down 1.55%, DJ Shanghai down 1.98%, Hang Seng down 0.94%. And the Taiwan weighted when it closed on the 22nd was down 2.68. All right, so those are the markets for today. Let's bring up the chart and just take a peek at it. So here's the Dow Jones, opened here this morning and was opened down, got up as high as about it was up about a third of, or 0.3% at its peak, and then just fell apart here at the last, what time was that? About last 15 minutes of the trading session. Different looking chart with the S&P 500 opened up, was up about at its peak, about 0.3% also, went up, up, and then kind of hugged the flat line for most of, late or mid morning. And then crashed again late in the afternoon. The NASDAQ looks very similar to this, and it was up as high as about 0.6% for the day, and then finished off in the red. So those are the markets for today. Exciting stuff, I know. I know you're on the edge of your seat with this sort of stuff. Let's go and get over to the market recap. U.S. stocks struggle for direction as focus shifts to Alphabet and Tesla earnings. All right. U.S. stocks edged higher on Tuesday, tempered by cautious trading ahead of quarterly earnings from major tech companies. Alphabet and Tesla are set to begin earnings reports for the Magnificent Seven tech cohorts, which includes Apple, Amazon, Meta, and Microsoft. Alphabet's earnings will offer insight into how the tech giants are benefiting from artificial intelligence and their investments in the technology. Tesla's report will focus on how the electric vehicle maker is handling decreased demand and its advancements in AI-driven autonomous driving and robo-taxis. Mixed results from other companies. Coca-Cola rose nearly 1% after raising its annual organic sales and profit forecast, indicating strong demand for its beverages, both domestically and internationally. GE Aerospace surged over 6% following an increase in its annual profit forecast due to strong demand for its aftermarket services, including jet engine parts. Conversely, General Motors dropped over 6% after announcing delays in the rolling out of a new Buick electric vehicle and postponing plans to open an EV truck factory, citing a need to match investment with demand. Yeah, there's probably not a lot of people out there who want electric trucks. I mean, there's those, I guess we would have called them, preppies or what were those people called back in the 80s? Yuppies. Yeah, yuppies who drive, they want to have a truck, but they never take it off the pavement and it never gets dirty. The bed is perfectly, just like it's brand new. My trucks are never like that. The beds are always scratched to hell just because I throw stuff in there and they get all beat up. I try to take care of the exterior, but, the part that's for hauling stuff, it's just going to get wore out. All right, jumping back in here, United Parcel Service slumped more than 13% following disappointing second quarter earnings driven by revenue weakness in its domestic business. Upcoming earnings surge. About a quarter of the S&P 500 is set to report earnings this week, promising an intense period for market activity. Well, today is definitely not that. And then political uncertainties. Investors are also watching the U.S. political landscape with Vice President Kamala Harris likely to become the Democratic presidential nominee after President Joe Biden announced he will not seek re-election. Recent polls indicate Republican nominee Donald Trump is currently ahead of both Biden and Harris, although Harris's official nomination could impact this trend. Trump has expressed willingness to debate Harris if she secures, easy for you to say, the nomination at the upcoming DNC convention. And then wrapping up here, Ether fell over 1% after the first wave of Ether spot exchange traded funds began trading. These ETFs issued by companies like BlackRock, Fidelity, and Invesco marked a significant development following the launch of spot Bitcoin ETFs just over 6 months ago. All right, so that is the market recap. Let's hop into some data that came out today. June existing home sales. This comes from First Trust, and Bryce Gill, an economist there, is the one who prepared this. The typically robust spring selling season failed to emerge in 2024, with home sales actively declining by 5.4% in June, marking the fourth consecutive month of decline. The housing market remains sluggish due to persistent affordability issues. Key factors contributing to this downturn include mortgage rates staying above 7%, causing potential buyers to delay purchases in anticipation of the widely expected Federal Reserve rate cuts. Additionally, home prices could continue to climb, reaching a new high in June, with median prices of existing homes up 4.1% from the previous year. So, again, I know I say this all the time, but I mean, if we go, say the Fed funds rate goes from 5.5 or from 5.25 to 5.5 to 5 to 5.25, I mean, well, that 0.25%, I mean, is that really going to make a huge difference in the economy? I personally don't think so. I mean, other than just the average, normie out there who's, not really paying attention, they go, oh, rates are going down. That's good. Things must be going okay. Granted, those who look under the engine or look under the hood and know that the engine's held together with duct tape and Bondo, it's pretty rough out there. Assuming a 20% down payment, the increase in mortgage rates since the Federal Reserve started its current tightening cycle in March of 22 translates to a 45% increase in monthly payments on a new 30-year mortgage for the median existing home. While the housing market can eventually adapt to these higher costs, ongoing volatility in financing will cause continued disruptions. Sale of homes priced at $1 million and above have risen by 3.6% in the past year, contrasting with a 5.4% decline in overall existing home sales. This indicates that buyers and sellers in the higher end market are adjusting to higher rates. However, many existing homeowners outside this segment are reluctant to sell due to being locked into their lower mortgage rates obtained before 2022, which significantly limits future sales and inventory. Despite these challenges, there are signs of progress. Inventories have increased by 23.4% over the past year, helping to push the month's supply of homes up to 4.1 in June, the highest since May of 2020. However, this figure is still below the 5.0 benchmark that the National Association of Realtors considers indicative of a normal market. The tight inventory of existing homes means that while the pace of sales is reminiscent of 2008, it has not led to significant declines in prices. In other news, the Richmond Fed Index, which measures factory activity in the Mid-Atlantic, fell to negative 17 in July from negative 10 in June, indicating a downturn in manufacturing in that region. All right. So that's some awesome news. And last up, got an article here from Zero Hedge titled Signs of Severe Credit Card and Auto Loan Stress in Gen Z. That is not good. And this was authored by Mike Shedlock of mishtalk.com. All right. The U.S. economy is showing signs of slowing down, which is expected to hit younger generations, particularly renters, the hardest. This perspective comes from an analysis by Mike Shedlock of mishtalk.com, drawing on recent data and reports. Higher inflation and interest rates have left consumers deeply in debt, despite claims of a robust overall economy. Indicators such as jobless claims, which have averaged 235,000 per week in the last 4 weeks compared to 211,000 in the first quarter. Point to economic strain. Continued jobless claims are rising, and overall retail sales have only increased by 0.2% over the past 6 months, failing to keep pace with inflation. Big banks are also feeling the pressure from higher rates. JP Morgan reported a 9% decline in second quarter profit year over year, with a significant increase in charge-offs on loans. Wells Fargo's CFO highlighted that consumers on the lower end of the wealth spectrum are struggling more. Auto loans and credit card delinquencies are on the rise, with Gen Z and millennials particularly affected. According to the New York Fed, 33% of maxed out credit card users are delinquent, with the highest delinquency rates seen among Gen Z. Renters are also struggling, with over 25% having unpaid bills, indicating financial distress. Home ownership rates show that younger generations, including Zoomers and millennials, are less likely to own homes compared to previous generations, exacerbating their financial challenges. Political implications are significant, as younger voters and renters are increasingly dissatisfied with the current economic situation, potentially impacting the upcoming presidential election. Not that the president has a whole lot to do with here's what I say. Those in politics don't really help the economy. What they can do is really hurt the economy, with excess regulations and, just the meddling that Washington likes to do. So, the more they stay out of it, in my opinion, the better the economy will be. And if you could reduce as many regulations as possible to keep people from killing each other and stealing each other's money, I think that's probably the way to go. But, the Yankees up in Washington love to tell everyone else what to do. All right. Biden's attempts to introduce rent controls and other measures may be too late to alleviate the economic pressures facing these groups as the economy continues to weaken and the likelihood of recession increases, bringing further challenges for both the economy and political stability. And then that last piece about trying to put price caps on rent. Again, show me in the Constitution where the federal government has any jurisdiction over rents or rent control or anything like that. And, I'll be happy to go along with you. But until that time, there's no jurisdiction for the federal government to be poking their nose into that. Those are local issues, county, city, state. I'd rather that stuff get handled at, as close to the people voting for it as possible. And, that's where the county and the cities are probably best. All right. Well, that is everything that I had for today. If anyone needs anything from me, please go to, wait a minute, DSAFinancialGroup.com. All my contact information is there. If you need to get your financial crap together so that you can, buy a house or, be able to afford the things that you want in life, give me a buzz. I'd be happy to help you get your financial crap together. All right. Well, that's everything I had for today. If anyone needs anything else from me, like I said, go to my website. All my info's there. Otherwise, I hope everyone has a fantastical evening out there, and I'll talk to you next time. Adios.